Thank you for the introduction, and thank you FSM1 for organizing this major annual event. It's my honor to be with you this morning, coming lunchtime, to share with you a bit of the recent developments, interesting trends of the Singapore ETF market. And I think most of the presenters today, they are part of the ecosystem, critical piece of it. It's our pleasure to be with them as well today at the booth, the exhibition hall, to share with you a bit more in details on each product. So given their presence, I won't go into each product specifics, but my intention is to give you an overview of how they come together and how together they can form a critical piece of any investor's portfolio, be it for income or be it for growth. So this is an important one, a disclaimer. So while you guys are reading through it, I'd like to do a quick survey. A show of hands, anyone here already own ETF, be it US, Europe, Singapore, or any other markets? Quick show of hands, just a quick survey. Okay, hold there. Any of you are holding Singapore listed ETFs? Okay, actually, it's a good mix. So I think FSM1 did a good job in promoting our ETFs. So I'll move on to the proper. So today, ETF has become a very mainstream investment tool. Right? I remember when I first joined SGX back in 2019, our AUM of investors from someone like yourself, combined flows is about 5 billion in AUM. We have grown by 4 times since then. Now we're at 21 billion. In fact, over the last 12 months, we have brought in another 4 billion, which is almost the entire size of our ETF market 6 years ago. Today, we have 53 ETFs. Most of the issuers are present with us today. Again, if you want to find out a bit more about them, do visit their booth. We have a game as well on our booth. You want to participate in the game. After my sharing, we should be resuming that game. Last but not least, if you look at our daily turnover, which is, I think, is an area that a lot of you are concerned about, whether there's enough liquidity trading. The good news is that we have seen a lot more participation over the last 1 year. Our trading turnover has also grown by 100%, which again, thanks to many of your participation. Last but not least, we have a lot of interest coming from investors using their SRS as well as CPFIS monies as well. So for those who do not know, all SGX ETFs are available under the SRS schemes. So that is one of the easiest and lowest cost way to invest your SRS monies if you are intending to build for your retirement. There are about 6 ETFs, including 4 from Amova that invest into one of the STI ETF that kind of shared earlier on. It is eligible for a CPFIS OA account as well. Beyond that, I think one of the most helpful initiatives that FSM1 has done is to waive all processing fee for regular savings. So today, I think close to half or more than half of our ETFs are also available on FSM1 platform through regular savings plan, which combined, we have seen the AUM of more than 1.6 billion today. So again, if you do not know when to buy, how much to buy, sometimes the regular savings DCA is a good way. So I will just start off. I think roughly half of you didn't raise your hands earlier on, so this might be helpful for those who have yet to decide whether ETF is a good way for you to build your wealth, right? So why ETF has gotten so popular? First of all, what is an ETF, right? Most of you might have bought stocks from the exchange. Many of you could be Fund Supermart's clients, so you are not new to unit trust. ETF really merit the advantages of these two instruments, right? So with ETF, technically you can trade in and out of your position during the day instantly, and you enjoy the diversification of a basket of underlying. So if you don't recall what's the advantages, just remember E can be stand for efficient, efficiency, low cost of execution, transparency, It means that you can have disclosure in your underlyings on a day-to-day basis. You have full daily pricing transparency as well. For those of you who have bought unit trust, probably you won't see the daily price until end of a day or even a few days later. For ETF, it gives you the intraday pricing. Last but not least, which I will spend a little bit more time on, is on portfolio and why ETFs can give you the flexibility of constructing your portfolio, either for growth or for income. Okay, start off from cost efficiency. I think Kenneth shown a slide earlier on the compounding effects of STI. But bear in mind, returns compound, but so do your cost, right? So this is a chart showing individuals, assuming you invested $1,000 every month into an index that pays you about 7% or rather 8% annualized over 28 years. $1,000 a month technically can bring you to $1 million savings, right? $1,000 a month, $1 million in 28 years. But if you were to be paying more than what you should be, assuming after fees you're only getting 6% rather than 7%, there is going to be a very big drag on your performance. And we are talking about 15% differences, right? So bear in mind, while your return compounds, so do your cost. Hence, total expense ratio of an ETF is one of the key metrics you should be looking at. And that brings ETF into the picture because ETFs are generally lower cost than most of the other unlisted funds. Next one would be on trading efficiency. For those of you who have been buying unit trust, I think when it comes into buying subscription and redemption of your unit trust, you would have experienced the fact that you don't really know what price you're buying at. You don't really know what price you're selling at, right? Because all you do is you submit an order for 10K, you submit an order to sell for $10K, but really what price are you liquidating or investing at? You wouldn't know until you were given the NAV 2 days, 3 days, or even 5 days later. So ETFs allow you to know the price you are paying or you are receiving instantly because the moment you've done your trade, you have locked in your prices, right? I think that is one of the most powerful tools that investors could think of. And when it comes to portfolios, when you rebalance your portfolio, right, I think it's important for you to be able to execute a buy and a sell on two different underlying at the same time, right? Why? Because assuming you think that US market is overvalued, you want to reallocate some of your holdings to Singapore, ETFs allow you to sell US and buy Singapore equities ETFs instantly rather than waiting for a few days to receive your money and redeploy. So that is one of the reasons why ETF has gotten so popular. It allows you to play around or rather reallocate your assets within a single moment. Last but not least, on T as well, transparency. I think this is something that investors underappreciate when it comes into investing. When you are buying a unit trust or mutual funds, do you really know what it offers you? Do you really know what you're holding? Right? You might not know. I think some of the unit trusts, they only show you the top 5 or top 10 stocks that you're holding. But ETFs, on the issuer website, you can have a download of what it really holds. For STI, very straightforward, you own 30 stocks. And the file that you can access to every day gives you the breakdown on how much each companies you are holding. And that is the transparency level that you're getting. You know fully what companies you have vested into. And so we move on to the next topic on portfolio after covering why ETFs, right? ETF stands for efficient, transparency, and flexibility. When it comes to ETF portfolio, this is where we touch on the flexibility, right? In general, I think for most investors, you would have 5 or even 6 building blocks that you are looking at. First of all, Singapore equities, which I hope you have enjoyed the session from Kenneth. Global equities, there will be some sharing on US markets. I think that's where it might come handy later on. REITs, which again is one of the darlings of Singapore investors, fixed income, money markets, short-term bonds, and last but not least, gold, which I believe my good friend Shin Xiang has given you a very detailed sharing on why gold ETF earlier on. So I was going to start off first with those of you who are seeking for growth, right? So what type of growth are you seeking for? What type of exposure are you looking out for? In Singapore, I think most of you will have learned a lot from kind of sharing about STI, both historical and what holds for its future. On SGX, beyond STI, we do have a few other options that you may want to take a look at. I was just chatting with some of you guys earlier on and shared that we do have issuers like Lion Global, Phillip Capital, right? They do have other ETF underlyings that buys into Singapore market, that focus on dividend, that focus on low carbon. So do visit their booth if you want to find out more about STI ETFs. Regional ETFs. So you don't really have to go into regional market like Hong Kong, Japan to have access to these regional companies. Because the good news is SGX, we do have a lot of these regional companies ETF as well. Again, the issuers are here today to meet them and find out more about how you can access markets like China, Japan, South Korea through ETF. Last but not least, for those of you who are looking to invest into the world leading companies in US markets, US ETF is one of the available options. We don't have many US ETF today, but the good news is we are working very closely again with the issuers. So do keep a lookout for new launches in coming months so that you can again have more options to build into your portfolio. Next, I'm going into income, right? This is something that touches many people's hearts. What are the options for income ETF? Again, I'm just going to, because I was enjoying kind of session, just going to bring out the point he mentioned about the T-bill rate. Currently, it's about 1.4. Is there any alternatives, right? Here are three big blocks of opportunities for investors. Either you go after stocks that generate dividends, like STI ETF, REIT ETFs. Currently, there are 5 REIT ETFs, right? They are issued by Lion Global, UOBAM, Amova, CSOP. They give you regular income. Why? Because REITs, typically they pay more than 90% of their rental income to the investors. So without owning a property yourself or more properties yourself, REIT ETFs allows you to be a landlord in the major offices, buildings, retail malls in Singapore. Last but not least, bonds, ETFs. This is probably one of the least appreciated, based on the statistics we have, one of the least invested, least appreciated asset class in ETFs by local investors. I believe the reason is because a lot of investors, when it comes to bonds, first thing that came to your mind is probably T-bill, Singapore savings bonds, and some of you who are more sophisticated, on and off issuance of corporate investment grade bonds. Bond ETFs allow you to have quick, easy, a variety of access into the options that I mentioned earlier on. For those of you who are looking for a little bit more yield pickup, but wants to stay within the investment grade space, we do have, again, bond ETF that meets the needs. It gives you more income than a T-bill if you are willing to take on a little bit more in terms of risk. So together, these three, again, the portfolio construction on the right side, it's not an advice, but what you could really do is to use some of these options to construct a very diversified portfolio to supplement your income. Why? Because these asset classes, these 3 asset classes, they may behave differently in different market cycle, and this allows you to stabilize your income stream. And putting them together, you don't have to go all in growth or all in income. Why? Because if you're 100% growth, you must be able to stomach that volatility that comes into it. Are you able to sleep soundly at night if your market got a drawdown of 20 or 30% this morning? And you don't have to go in all income because many of you still have a long horizon towards retirement. You want to make your money compound harder for you while receiving income. I think that's where you can come into a balanced portfolio. Balance meaning that you have a good mix of equities and bonds, so that if your equities market is performing well, you reap the returns. But if there's an equity sell-off, if equities market is having a correction, your income element is going to help you to buffer your losses. So a few months ago, I came across this interview by John Bogle. I'm not sure if you guys heard of John Bogle. He is the founder of Vanguard. And the interview was about portfolio construction. The interviewer was asking him, what is your portfolio mixed? And he gave a rather interesting reply. He is 50% in bonds and 50% in stocks. And the reason was very simple, because as human being, if you have bought a stock, right, 50% of the times you will regret you didn't buy more because market rally. But 50% of the time, you will have scolded yourself for buying too much because the market went down. So end of the day, for those of you who want to be rather neutral in your approach, a 50-50 allocation, that's what he has gone for, and that was what stuck to him throughout most of his investing life. So again, there's no right mix for allocation. A lot of traditional asset managers advocate 60-40. Some say it's due to back-tested results. It gives a strong risk-adjusted returns. But then again, there's no right formula for individuals. If you could stomach more risk, your allocation to equities generally is higher. If you can't stomach that more risk, your allocation to income like REITs, bonds, could be a bit higher, because at bad times, their income is going to buffer your performance returns. And also on this page, you realize I added gold as well, right? A small location in the illustration, about 5%. Why gold? You have heard enough from Xinxiang, right? But just to re-emphasize to share one of the study made by World Gold Council, an allocation between 2 to 10% on any investment portfolio is likely to, again, offer a better, stronger risk-adjusted returns, because gold itself serves a few purposes. It's an inflation hedge. It also has a much lower correlations with the traditional asset classes during bad times. So I'm just going to quickly run through that. How do you build your portfolio, either for growth, for income, or for a well-diversified portfolio? There are 5 Singapore ETFs today. 2 of them did not introduce more, STI ETFs. But there are 3 more that are really rather interesting, that allows you to either focus on the high dividend ETF like Philip Sing Income, or expose into a wider pool of Singapore companies. And when I say that, I mean Lion OSPL Singapore Low Carbon, as well as Extracus Singapore UCITS ETF. These 2 allow you to invest into companies beyond Singapore listed. You can also gain exposure into overseas company like Sea Limited and Grab Holdings via these 2 options. Again, do look for Lion if you want to find out more about that ETFs. On the right side, that's where things get a bit more exciting, right? If you are investors who really wants to go beyond Singapore companies, we do have a wide range of ETFs that offer you China exposure, Japan exposure, India exposure, as well as the regional market exposure. So one of the ETF, personally, I think is quite under the radar is the recent launch by Amova, right? Asia X Japan X China ETFs. They launched it last year, April. AUM is quite decent, 100 million now. But what the name of the ETF doesn't tell you is that the top 3 holdings are TSMC, Samsung, and SK Hynix. Tech companies make up, I think, about 60% of the ETFs. So again, ETFs give you the full transparency, right? So don't just rely on the name of the product to choose the product. Do look at what the fact sheets and the the key highlights of the ETF before you make a decisions. On income levels, right, we have a booth that gives you more information as well if you do visit our booth later. This shows you the dividend you can get across different asset classes. ETF investing can be really, really easy, right? Because end of the day, what you are holding in your portfolio is what the ETF wraps itself over. So when you look at some of the REIT ETFs here, what you're owning is simply a portfolio of, let's say, 17 or 21 REITs, which many of you are familiar with, at a single trade. Some of the bond ETFs, right, iShares Asia High Yield Bond, Amova IG Corporate Bonds, what you're holding is really 200s over bonds, which otherwise is impossible for individuals to access to in a single ETF. And why bond ETF makes sense? Because if you were to invest into a high yield bond, a speculative grade bonds, it carries a lot of risk, right? Because if that company defaults, it's a total loss. But if you invest into a diversified bond ETFs, your risk is being diversified or mitigated over hundreds of issuers. And that's what makes a bond ETF a lot more powerful than a single bond investment. Last but not least, for those of you who are seeking for more diversity in your portfolio or who are seeking for liquidity needs, because although you want to stick to the portfolio for years, at times you do want to have the flexibility of withdrawing. This is where money market funds can help your portfolio, right? Because money market mainly invests into T-bills, into banks deposits. The risk of drawdown is very small. And likewise, if you are looking for investments like gold, this forms part of the available options to you as well. So how do you then, from that 50 over options, choose the ones that fits your needs? There is a screener. That's the QR code on the left. On the right, we do provide reports as well on how some of these ETFs are performing from time to time. So these are probably the 2 QR codes you could scan and bookmark on your phone. ETF screener comes with filters as well. So you can choose ETFs that offer dividends as well as break it down into the currency that it offers. And why currency? So this page gives you a few reasons on why you should look at SGX ETFs. There are thousands of ETFs globally. In fact, the world ETF AUM has crossed 20 trillion, right? But then why are you looking at the market locally with about 21 billion AUM? It brings you a few advantages. Trade during Singapore market hours, right? Is something natural for the locals. You can choose to consolidate all your investment into a single local exchange, local CDP. S3D denominated ETF counter, right? So for those of you who are invested in overseas, I think one of the headache you would have faced is really about when to convert your currencies. And the worst deal is after you have sold your investment, what do you do with your currency? Is that a good rate? Are you waiting for a better rate between dollar and Sing to transfer, to convert? I think that's a headache you can relieve yourself of if you do a Singapore listed ETFs. The fourth one is the powerful one, right? For those of you who are yet to contribute to SRS, you should really find out more about what helps you and use ETF as one of the tools for your investment. I don't have it on the slide now, but today, over $1 billion out of the 23 billion SRS contribution goes into Singapore ETFs. So that's what most of the investors are doing. Last but not least, we are working very closely with distributors like IFAS to make it available via your regular savings plan. And next slide, this is purely about DCA, dollar cost averaging. For those, one of the common questions we always receive when we speak to investors is, how do I get started? Do I do lump sum? Do I do dollar cost averaging? I have 100,000 now. Should I buy everything now or should I split it over months? One thing to share is that we have observed a very strong DCA trend across our partners. A lot of investors are using DCA as one of their, DCA stands for dollar cost averaging. as one of their investment vehicle. So the chart here shows that if you have DC8 into the STI ETFs since end of 2019 till last month, you have generated a compounded average annual growth rate of about 10%. And what does it mean? If you have done a lump sum investment right at the start of 2019, you have a return of 12%. So it shows that DCA, lump sum, the end results, typically it should be about the same. However, there are studies made that lump sum always works better. But bear in mind, caveat is that lump sums works better in a bullish market. If the market is choppy, right, DCA could be a way for you to sleep better at night. Volatility certainly has smoothed out as well, because if you were investing on a regular basis, you would not be able to ride through the highs and the lows, the maximum highs and lows of the product. And last but not least, today we have a lot of channels available, including via iFast. So iFast is a very interesting product called the beneficiary account. My friend has started. I spoke to a few of the audience. I think they have been using beneficiary account. They have been doing DCA for your client. So if you look at my slide earlier on, $1,000 monthly, 28 years for your kids, that's $1 million savings if they invested into a product that gives a historical or rather forward return of 7%. So how do you get started? Right? A few key points to note. I'm not a financial advisor, so please do advise your financial advisors. Don't just purely rely on the sharing today. First of all, always define your investment objectives. What are you building this for? Do you want a Sing dollar, a strong currency income portfolio? Or are you looking for a globally diversified growth portfolio, right? Choose the markets and geography. Are you investing locally, globally? Choose the sectors or theme. Are you a believer that tech will continue to run? Do you want to have more Asia tech companies in your portfolio? Growth versus income. Now, this is important, right? Do always know what you are going for, right? If you are going for income, bear in mind that the traditional tools would be REITs, bonds, dividend stocks. Going for growth, in the long term, pure equities always works better. Right? Always go in knowing fully what is underlying and what you're going for. Liquidities and time horizon. Again, if you have a short liquidity or high liquidity needs short time horizon, I think money market short duration bond could play a good role in your portfolio. And last but not least, once you have selected the ETF, check out their historical performance. Do a quick simple math in looking at what's the weighted average drawdown of your portfolio. I think that will at least give you a number in mind on what its volatility could be like. So coming to the end of the sharing today, right? I just want to re-emphasize 3 of the main takeaways I hope you have for my sharing today. ETF is no longer, unlike 6 or 7 years ago, I think it's no longer or whether I should. To me, it's almost like a trend of a smartphone, right? 20 years ago, you never expect everyone to be holding smartphone. But if you're looking across the whole world, as far as US, Europe, rest of Asia, ETF has become a daily necessity for many, and which is why we as investors should learn to embrace them. ETF can be used for multiple objectives. Normally, it's for growth or income, but at times you also use for liquidity needs. And most important point is this: we do have a very wide range of ETF available. Right at about 1:30, we will restart our game at our booth. So do visit us. For a small gift, you get answers correct. Okay, thank you everyone for your time.